Mr. Sindwani.
Good afternoon, Mr. Keshavan.
Greeting.
My
How are you?
apologies for some. All well, all well. I'm really apologetic and sorry for that delay on my part. There was some mess up happening over here in my Wi-Fi connections over here.
Oh,
So that's why when you're having nowadays, we have become so dependent on the Wi-Fi connections that everything life comes to a standstill. Suddenly, if things go, you feel like as if your lifeline has been cut out. So,
yes, it's like
thanks a
oxygen
lot.
for us.
That's true. That's true. So I will just, I think we have got people already locked in. I can see more than 50 participants already here. So what I will do is, if with your permission, we can just set the ball rolling. And in the meanwhile, I'm expecting maybe many more people would be joining in. So good afternoon, members, participants, and welcome to the FEDI monthly discussion forum. And may I request someone to please give me a confirmation that you are able to hear me? Somebody on the chat mode, if somebody can just give me a signal. Now, because I have recently got out, okay. Mr. Dhanendra Kalra has confirmed. Yes, sir. Thank you. Thank you, Mr. Kalra. Thanks a lot. So now, just because, first of all, I would like to apologize for the delay on my part for logging in over here. As I was telling to Mr. Keshavan that, yes, I had some problem with my home Wi-Fi connections, and that things were so messed up that it was not able to pick up the right connection and then to log me on. And that took me some time, though we had really in discussion with Mr. Keshavan kept some time spare for this. I didn't expect that it will delay the entire process, but I'm sorry for that.
No problem.
And I must also acknowledge that nowadays we all are going through some difficult times, and though we expected this phase to get over very soon, but it's got extended beyond our imaginations. And I know it's not easy, taking a lot of pressure, mental as well as physical pressure for us to keep the wheels of the economy churning and keep the things going in this difficult environment. And I'm really thankful to you for having spare time to join us for this meeting at these difficult times. And I hope that all our participants, you are all safe and taking sufficient and adequate precautions to keep yourself well protected, not only yourself, but also your friends and well-wishers and nears and dears, everybody, and wish you all safe times in this difficult environment today. So with this, I once again welcome you all to our FEDI monthly discussion forum. As you know that we started having this monthly discussion forum just 3 months back, and today we are having our third meeting in this series, and I'm very happy to welcome Mr. Srinath Keshavan for this discussion of ours. As many of you, I'm sure, would be knowing Mr. Srinath Keshavan. He is, I don't know where to start from. He has been a banker. He has worked in the corporate side. He has worked in India. He has worked in the offshore market. He has seen not just the buy side, the sell side, as we commonly say, but he is also now has been playing a very important role in bringing various participants, various players together. And he is a practitioner, a trainer, a banker, an ex-corporate person. And I think it won't be proper on me to give in an attempt to and to give a kind of introduction. I'm sure I will be missing out so many things. So I'll request Mr. Keshavan to himself give us a brief about himself, about your long successful journey through various stages of your career in banking, and also about little bit about your current role, how you are helping the market, the industry, and what role you're playing in that. So welcome, sir, to this monthly discussion forum, and over to you.
Thank you, Mr. Sindwani. Am I audible?
Yes, yes.
Okay, great. Greetings from Singapore to all who are listening in and tuned into this discussion. I'm indeed honored to have been invited by Mr. Sindhwani to present myself at this august gathering. So I thank you for your interest and your time. So to very quickly sum up how I reached where I am today, when I went into college and later post-graduation, it was with the intent of training to become an accountant, because that's what my father wanted me to pursue. As things turned out, I ended up doing a lot of mathematics at university, along with some study of economics and statistics. And when I got out of my master's, finished my master's and came out, I did my master's in Kanpur. I did my undergraduate in Mysore. I came out, it was not the best time in 79. This was 79. It was not the best time to search for jobs. So essentially you took whatever came along, and whatever came along for me was a management trainee position with Calico Mills, a firm that I don't believe exists anymore. Calico Mills, legendary name in the textile industry in Ahmedabad. So I moved to Ahmedabad, joined as a management trainee. And by chance, I was assigned to the exports department. So that was my sort of incidental entry into international trade. So as a management trainee, I was learning the ropes of the product and the industry and how to sell. And my essential function was to develop into a salesman. Anyway, I did that for a few years. Later, I moved to Usha Martin Industries. At that time, it was called Usha Martin Black. That was the early 80s. So I moved from Ahmedabad to the other end of the country, which is Kolkata. And I continued with essentially a market sales and marketing role in the international division of Usha Martin Industries. In the mid 80s, personal circumstances drew me to Hong Kong. And again, in search of something to do. And I thought my natural landing point would be another trading business or international business position. But as things turned out, my attention was caught by a starter position, again, as an officer trainee position with an international bank. It was the Bank of Credit and Commerce. And in Hong Kong, they had a very significant presence. The bank had, as I recall, 27 branches. The staff strength was in excess of 3,000. And after London, Hong Kong was the largest center for the bank. Those of you who might recall the bank essentially was focused on two types of businesses. One was retail banking, particularly in places like Hong Kong and in the UK. And the second was trade finance. So that's how I managed to find my way into the trade finance field. And that's an area that I've been devoted to since 1985. So it's something that I find intellectually stimulating. It's an area where I'm still learning. I find it extremely interesting. And so that has kept me going for these last close to 40 years. So in the bank, of course, I did a variety of things. I started in operations, moved on to the front office, became a relationship manager. And at some point after that, the bank blew up. There were actions against the bank. And when I hear about events on financial crime that are occurring in the early part of this century, the 2000 to 2010, the BCCI scandal was, I would say, minuscule in nature. But anyway, things happened, the bank shut down. I again found myself at a crossroads. I had at some point considered wanting to make my way towards Singapore, and as luck would have it, an opportunity came my way to join as a financial controller of a cotton trading firm. It was a joint venture company between Indonesians, Indians, and Taiwanese. So that's where I switched from banking to corporates. This was in the early 90s. And finally, for 10 years, I stayed in the corporate space, heading the trade finance function. And following that, again, as I said, it's all been a journey of incidental moves. I got to training, and I continue to be significantly in training. And 99% of my audiences are from the banks. I teach trade finance at different levels in different geographies, but based out of Singapore. And of course, in the recent past, it's all been over Zoom. So that is one preoccupation. I wear another hat, which is to pursue the interests of fintech enterprise. And given the opportunity to talk about that at a later stage, I'll be happy to expand on that particular theme as well. So that sort of brings you up to date on everything I've done since I left college.
Thanks a lot. I'm sure that would have been really an interesting journey, starting, can I say, Ahmedabad to Singapore tak.
Exactly. It's been eventful and yeah, a lot to remember.
That's, I can see you have worked with the best of the companies in the sector, though as the situation would have it, they may not be existing today for whatever the reasons or otherwise. But right now, right starting from Calico, they were considered to be the industry leaders for their final product governance and best industry practices and all that.
At one time,
That's
yes.
really interesting. Yes, and since now you are currently your key focus area is trade finance, and that is what is the area of interest for our audience as well. So I'll be coming directly to that particular topic and would like to hear from you basically how you perceive. We know in the banking industry, whatever I have learned or whatever I've heard from my fellow peer group people and otherwise, that lending is an integral part of the bankers and lending in various forms. It may be sometimes fund-based, non-fund-based, or some whatever the support you're providing. But within that lending area, the trade finance funding is considered to be something better than the other traditional working capital lending or the term loan or whatever the other purpose is. That's the general perception, general feeling you get. That's the preferred business. Given an opportunity, banks would like to go for this rather than going for the normal working capital finance or maybe any other kind of funding support to the borrowers. Why
Correct.
is it so? Why you think, what is in your opinion is the reason behind? How is the trade finance different from any other form of funding from the banks to the corporate?
That's a great question to start with, Mr. Sindhwani. Trade finance is a form of transactional lending. So it's tied to a specific transaction. And we describe trade finance to be essentially short-term, secured, and self-liquidating. Now, if you compare that with general corporate lending, including in the form of working capital finance, it could be in the form of loans, it could be in the form of overdrafts, and other forms of fairly liberal terms of lending. In trade finance, it's an essentially far more disciplined process. You know full well at the time when a customer comes to you that the bank is required to issue some sort of payment instrument or fund a purchase, specific purchase. So you have details of the purchase. You know exactly where the goods are coming from, where the goods are going to. You know all the details of the goods, how it's going to be packed, what are the Incoterms, what are the invoicing terms, price, value. So the level of detail and visibility that you have in trade finance is far greater from a banker's perspective than it would be from, say, the lender of general working capital finance. In general working capital finance, of course, depending on the standing of the client, there's considerable freedom for the borrower to apply the funds as they see fit. Of course, they're expected to use the funds in accordance with whatever representations they've made to the bank. But as such, nobody's policing them. But in trade finance, the bank has significant control over the progress of the transaction. There are also inbuilt, shall we say, protections. So while the transaction's in progress, control over the goods through control over certain documents is preferred. Goods are insured and the bank's interest is protected through that way as well. So there are certain inbuilt measures within a trade finance transaction while it is in progress. And it is precisely for this reason, the fact that it is transactional lending, so you know exactly where the funds, the bank's facilities are being deployed. You also know about the exact structure of the transaction, the nature of risk management, and that several events occur in the evolution of that transaction of which the bank is a part of. And therefore, that is why trade finance is universally considered a safer form of lending than generally giving out loans or overdrafts. And the statistical information collected by the International Chamber of Commerce bear that out.
Great. I think that was very well put. Some key points, if I can say, is that short-term secured and self-liquidating.
Self-liquidating, yes.
That's what is the key difference. But one point, maybe we'll come to that later also, but I leave it here for your consideration. You mentioned that the statistical data and also the report submitted by the ICC, that International Trade Review report, which they come out with every year, that also says that event of defaults, so the percentages of defaults in this kind of financing, this kind of lending is much lower than any other kind of bank financing. That brings to me to one point, which I don't know if anywhere it has been taken or not, but in the Basel Committee reports, or even in the Indian reports, when we look at it, capital requirement, capital consumption for this financing is kept requirements, or the risk weightages are kept at par with any other financing or any other thing. Do you think there is a case which, as an industry body or as an industry professional or as ICC or any other body, there is a reason, there is a case for us to make it to the regulators, through specific regulators, or from ICC directly to the Basel, to review those parameters and to see if there can be little more different kind of risk weightages and the capital requirements rules can be applied for this kind of financing than any other bank financing?
Yes, in fact, as I understand, ICC has been continuously engaged with the Basel Committee. And in fact, many of the world's leading banks, as well as the multilateral development banks, have joined that conversation to convince the decision makers or the wise people on the Basel Committee for Banking Supervision to look upon trade finance differently and recognize the distinctive features of trade finance that make it an inherently safer form of lending. So in a sense, that was to a degree addressed when under Basel II, you had the advanced internal rating-based approach. And in the advanced internal rating-based approach, there was some leeway given to the qualified banks to be able to assign loss given default and the exposure at default. So that helped up to a point, and sort of it did give a sort of a competitive advantage to those particular banks. The others had to deal with a standardized approach where the central bank would hand down the norms on which the risk models will be operated on, and the capital adequacy ratios would be determined by. But it's an ongoing conversation, and I'm sure there's considerable movement going on. There has been, Basel III was a reaction to what happened in the global financial markets, and which was not at all trade finance related. But trade finance became a casualty of that, particularly when it came to the measurement of the leverage ratio, because we're taking off balance sheet items together with what's on balance sheet of a bank, and then determining what the ratio of the bottom line of the balance sheet is vis-a-vis the capital level that the bank is maintaining. And the trade finance community did come out vociferously to say that, look, trade finance cannot be lumped into the general basket of corporate lending by virtue of the fact of the features that I've already described. And we haven't yet reached a point where there is preferential treatment for trade finance, but it's a work in progress, because everybody who's invested in trade is fairly unanimous in their opinion that trade finance deserves, shall we say, a lower risk rating, and therefore whatever follows from that should benefit trade finance. Moreover, trade is a very important development priority for particularly the developing countries. And so whatever can be done to encourage banks to support trade is critically important.
Right. I think you put it very clearly in simple terms, though I'm sure this is a topic which requires much more detailed discussion, and probably this is a topic for some other day, which we'll take it up and we'll take your time on this. It goes into a little bit more technicals also about how the risk weightages are calculated. But the point you made it very clear that yes, trade finance is something very important for developing countries and for the world as a whole. And as we can see from the numbers which keep coming out, I think keeping the 2020 as an exception and keeping it out, if you look at the data till 2019, I think the trade finance numbers, or maybe that overall financing numbers, had almost tripled in the last 20 years from 2000 onwards. And along with that, if you put together the support, financing support for the services sector also, which is another adding up to another 6 trillion odd, this is a total substantial funding facility support being provided by the banks and the other financial institutions. And that, I'm sure, would have contributed in a big way in the overall development and growth of the international trade. Though still there is a debate going on, there is a funding gap. Banks probably need to do a little bit more, or industry is still starved of the funds. So, but in the meanwhile, what we have seen in the last few years, there have been a lot many development on the product structuring in terms of the origination of the trade, in terms of the way the products are packaged, the bundle, new product ideas, the new index entry of the new players, or I can say that entire ecosystem of that particular industry has been changing very rapidly. If I may request you to just run us through this, what are the kind of changes which are happening and how these are changing, how these are leading to that consumer point of view for the end product delivery for the consumer, either in terms of better product structuring, better offerings, better pricing, improved efficiency, just a little. I'm not sure that this involves a lot many things. This is where the role of fintechs also, the company you are representing, that also comes in. And this also talks about maybe a lot of digitization, the new technology. But just as a brief, if you can just give us a synopsis of that, what changes you are seeing in the industry in the last few years. I'm sure we'll have to keep the current phase of it out of it, because no, not out of it really, because this phase also has accelerated some of the developments which otherwise may not have happened, because all the tools were there, but maybe we are a little slow on the digitization. But because of this phase, that part has got accelerated. There are a lot many changes happening. Just a brief synopsis of that, if you can share with us.
I will do my best, sir. What we attempt to do in assessing a trade finance proposition is trying to understand the underlying supply chain, the business. So what's happening in the business? What are the flows? So are we procuring raw materials for conversion into finished goods, or are we procuring certain goods to be traded on and distributed? What is the business model of the customer who is approaching us for the trade finance? What are the particular risks that emerge from that supply chain? What sort of contracts do the counterparties in the transaction have? And what exactly is the bank required to do? At what point is the bank required to intervene? So increasingly, we are taking a very granular approach to evaluating a proposition from a customer. Now, there are customers and then there are other customers. There are, of course, the very large customers who simply say, look, just make a facility available to us and don't ask us too many questions. And so we entertain that, particularly with the very, very large sector. But let's put that aside because they are a minority in every economy,
We call them the big daddies of the industry.
the big daddies of the industry. So the grant of facilities for them, it's not just trade finance. There's a whole range of other facilities, a whole package of facilities that is granted to them. And it's largely done on a balance sheet basis, the strength of their standing, et cetera, et cetera. So banks are hungry for that type of business because obligor risk is considered highly acceptable. But that is, like I said, the minority of the clients. They might occupy a significant portion of the resources of the bank, but they're still a minority of the clients. If we were to shift our focus to the middle tier and the SMEs, that is where this granular approach that I was referring to earlier becomes particularly important. It's an important way of trying to understand risk. I personally propagate the approach that when we're looking as a lender, when we're looking at a proposition, before I think about what is the risk to the bank, I first ask myself the question, what is the risk to this customer? Because they're engaged in so many business activities. How are they protected? What are the risks that they see from where they're sitting? And how are they managing those risks? And taking a leaf from that, then I get a better grasp of what the proposition is all about when it comes from the bank's perspective. We have a limited number of products that we offer in a bank. We can't always have the freedom to invent a product on the fly and implement it, although innovation is something that is spoken highly of. But banking is a regulated industry and you can't just do anything you wish. So the bank has certain mandates, the bank has certain rules and regulations, and within the boundaries as set by the bank, we will deploy the instruments and products and services that we have and try to match it as best as we can in terms of what the customer needs. As you know, trade finance has been somewhat old-fashioned in the sense that we're doing trade finance the way we did decades ago. I won't go as far back as saying a century ago, but decades and decades, it has been simply unchanged. And it's a very noticeable lack of traction in the automation and the modernization of trade finance processes. Now, a lot is said about the fact that COVID has accelerated the need. It has, yes, I acknowledge that. But the discussion on digitalization of trade finance is something that goes back as far back as almost 2 decades. There are companies and businesses that have been promoting these products for a very long time, but the take-up has been slow. And a large part of that inertia is that, look, we're doing things fine, we're good with what we're doing, we're comfortable with what we're doing, we're happy with what we're doing, we feel safe what we're doing, so why change? So the change makers in the industry have had an uphill battle in terms of getting a conventional majority opinion on changing the ways we do business. Because when the old way works, why break it? If it hasn't broken, why try to fix it? That has been sort of the attitude. But as we notice, particularly in recent times, some of the things we could take for granted, for example, availability of a courier service to move documents from one bank to another bank, something that suddenly became unavailable to us. We never imagined that we will have to deal with a situation like this. The inability to go to work because there's a lockdown and you can't send payments, you can't receive payments, you basically can't operate the bank in a normal fashion. These are things that we never imagined and we never really catered for. So as soon as COVID hit and the reality of COVID hit, the focus of banks and business was really about continuity, business continuity. And so all the growth and all the future plans that we had to be sort of put aside and we just had to cope with the immediate challenges that we were facing. And along the way, there have been a lot of discussion about digitalization. There's a growing realization now at the senior levels within banks that we really need to think about changing. Even at the central banking level, many central banks are heavily invested in this discussion. And they realize that we cannot continue with the old methodologies. And so in the next, say, 3 to 5 years, we expect to see a very, very dramatic change in the way in which banks transact, in the way in which banks operate, and the processes that they will be wedded to. And it's a work in progress. So it's not that we've already invented everything and that we'll see it applied in 3 years' time. In fact, as we talk about whatever new things we want to do, there are newer things that are being projected. And so the banker of the future is going to be somewhat a different personality than what many of us have grown up to be. So it's a whole different era. Another point which I'd like to add at this is that the makeup of the, say, the trade finance market has also changed quite dramatically. No longer are the banks the exclusive providers of trade finance. You now have fintechs, you have non-bank financial institutions coming up using technology. So they've also been in existence for more than 10, 15 years. But increasingly, with the regulatory constraints placed on banks are finding it difficult to occupy all the spaces in the market. And so that's sort of giving opportunities for non-bank institutions, fintechs, and other types of businesses to penetrate that area. So a lot of shifting is occurring. And we are trying to capture all these changes when we look at a survey, a global survey, but it's an extremely transformative experience that we are living through right now.
Great. Thanks a lot. As we are continuing with this discussion, I'm seeing some kind of comments appearing on that chat window also.
Sure.
So one of the thing which, since you were talking about fintechs and other thing, one point which I see over there, somebody has mentioned about is that fintechs have role in reducing the turnaround time for the fund flow. So what regulatory constraints you perceive, if any, from other countries like India? I think the way I look at it, fintechs have got a role not just in improving the turnaround time, but also in lot many other areas which you had touched upon. And about the regulatory constraints, would you like to say something on that about countries like India, which since we have got an overview of much wider geographical region?
I've already spoken about the, shall we say, the regulatory framework from a Basel perspective. I referred to that. The other challenge that banks are now dealing with are increased compliance requirements. Between 2000 and 2010, there were a large number of cases brought against the largest banks in the world by regulators and by controlling sort of regulatory control organizations. And a lot of banks paid huge fines for having committed financial crime compliance breaches. So we're concerned about money laundering or instituting anti-money laundering measures. We're concerned about sanctions evasion. We're concerned about capital flight. And increasingly, the banks are being imposed obligations to perform certain compliance functions, which quite naturally require the banks to collect a lot more information, and not just collect and record, but verify that information, and also institute processes as well as technology systems that enable them to check and verify that information. For example, in trade finance, by virtue of the sanctions restrictions that we have to be mindful of, we have to be careful about the ownership of a ship that carries the goods, the ports it has called on, the history of its sailings, things like that. So we get into that level of detail. And so it naturally preoccupies the bank, and everything cannot be at the click of a button. There's a phase-by-phase process by which banks have to go through, and there's a lot of recording of information. So I see compliance as a sort of putting a brake on the speed of completion of transactions. Again, there are technology solutions that are being continuously proposed, and it will take time for the banking system to adopt all of that, to figure out which is best for them, and then to adopt it as a matter of daily practice. But many of the nodal organizations like the ICC have been very active in spearheading certain initiatives. And there are, of course, other non-ICC organizations as well that have offered systems of compliance that would be helpful for the banks, particularly in the trade area. One of the activities I'm involved in is, as mentioned, that I'm a trainer. So I'm on also a panel of a global bank. And one of the tasks I perform is training the staff of the bank on financial crime compliance for the various businesses, whether they might be in retail banking, wealth management, trade finance, and the like. So there's a lot of emphasis on upskilling people on matters connected with financial crime compliance. Getting people up to speed on technology is a whole separate education by itself. So banks, again, are looking at new recruits very differently from what they used to at the time when I entered banking. And the type of qualifications they require is quite different. The type of experience they require is also quite different. But one of the key things, I guess, that is across the board for the generation that follows us is the continual interest and desire to learn and to expand horizons, because there is so much that's happening around us, and we need to be able to grasp all of that and put it to work for us. And that isn't a challenge by itself. As far as non-bank institutions are concerned, yes, they are definitely bringing in methodologies that could improve the efficiency of what banks were normally doing. And time will tell whether that will prevail. You see a lot of efficiency, for example, in the area of payments. We live the experience, and so we know how easy it has become to use mobile phones and use payment technologies and make transfers of money from here to there, whether internally or outside the country as well. So it's become, the use of technology is prevalent all across the board. And while we get over the ability to absorb and implement technologies, I think the outlook is that we're going to be a far more efficient provider of services. Probably not necessarily a bank, but as a provider of services, I think we will be, as a community, far more effective going forward.
In fact, that's something which we have all seen, our generation of bankers, the change, the pace at which the changes used to come in and the pace at which the changes are happening now is totally different. And I'm sure that, as you
Absolutely.
said it right, the new generation or the current bankers, they need to be much more agile, much more alert, much more open to the new ideas, and should be able to differentiate between good and bad and worse, and then to move with the right thing at the right pace. And AI and machine learning is going to play considerable supporting role. Probably we understand and are able to handle it better. We should continue to be the masters of that, not just become slaves of that. That's the key, for which that employee learning and employee training also is an integral part.
Absolutely.
That's something very important you have mentioned. Now, coming to this, with so many new players coming into fintechs, which earlier used to be NBFCs, now it's a new breed, which is, you can say, the combination of NBFCs and the technology companies, the fintechs. What we saw, the role they are playing in bringing the borrower and the lenders together. Sometimes they are providing better turnaround time, as we mentioned earlier. Sometimes they are also getting the right mix of the products in packaging of the product, getting that the right match between the borrowers and the lenders. They're playing a complementary role in overall development and growth of the business. But in the process, somewhere, are they also becoming a little bit more aggressive? What is the control and check on them? Because as one point which you mentioned, that banking is a regulated industry, and whereas this may not be, this still
Yes.
comes into that gray area, which is not as well regulated, or sometimes they are not regulated at all. So what are the checks and controls? And coming to that, the another point which we wanted to cover today, and is it, do you see the recent events which have happened in that world of the trade finance, which I'll put together, not only the trade finance, the commodity finance also, we have seen lot many recent things. Some of these were maybe outright fraud, some of these may be some aggressive industry or the market practices, some of these may be aggressive accounting practices. It can fall into different areas. Is it a result of that, because some new entrants coming in, the overall controls are getting diluted, things are going out of control, people are becoming a little bit more jealous, or people are becoming a little bit more lowering their guards when, okay, I'm happy with dealing with these people, this guy is taking care of my thing, I need not go through all those details. So what is it leading to? And maybe I would like to hear from you some of the recent experiences which we have seen in the industry. What was wrong in that, or what went wrong exactly over there, which led to these kind of fiascos which we have seen in the global environment, global world?
In fact, one of the concerns, if you're a consumer of financial services, which all of us are at some point and to some level, and as a governing body, the big challenges with the emergence of non-bank financial institutions and non-bank institutions per se, which includes the fintechs. The question you ask is, where is the regulation? Where is the oversight? Because these are all private enterprises going about their business, trying to find gaps in the market and monetizing those gaps. So recent events, for example, Greensill is a case in point. The business model of Greensill, when it started out, as I understand it, is a very simple model. It's an age-old practice. It's basically discounting claims on a highly rated obligor. So you've got a corporation, you've got several small suppliers. So suppliers are presenting goods to the big corporate, and the big corporate expects credit terms. So the small supplier, despite the fact that they can't afford credit terms, goes ahead and offers credit terms because they want the business. Then they turn to a supply chain finance provider who will help them with the funding by discounting the claims on that big corporate. So the model per se is an age-old practice, but it was supercharged, and there was an infusion of technology in order to make the processes a lot faster and expand the business again also a lot faster. But supply chain finance is something that has caught the attention of all the major banks in the world. And all the major banks have a very significant involvement in this area. But the way they do it and the way the likes of a Greensill did it were very, very different. So the first thing is that the major banks of the world are using, they're funding the transaction themselves. Whereas in the case of Greensill, they were buying up portfolios of claims on large corporates, and then they were funding it through a means where the claims on these big corporates would be securitized and then sold down to a fund that would actually finance Greensill and its ability to do more business. So the funding structure of Greensill was somewhat different from what the banks are doing. And in that way, they offloaded risk, they offloaded the funding pressures, and that enabled them, together with the funds that their investors were providing them, to expand aggressively. Now, this aggressive move towards grabbing market share, because there are many companies doing supply chain finance who are not banking institutions. But in a move to try to grab greater market share, clearly some compromises have occurred. And that ultimately led to the downfall of a company like Greensill. One question was, were the claims on the corporates really AAA rated claims? Were they of the high credit quality that they were supposed to be? Was there a mixture of lower rated claims in that portfolio sold to investors? That is one question. The second question was, and it was a very fundamental thing, you as a ex-banker would know this full well, and all the listeners would know this full well. Simple thing like concentration risk. If you're looking at any portfolio of assets, you should not be allowing for concentration risk to creep in, as otherwise it will skew the risk profile of the entire portfolio. But unfortunately, what Greensill ended up doing was focusing on certain parties to whom they sort of went excessively in terms of providing their facilities and funding, resulting in risk portfolios that simply were not representative of what it was intended to be. So concentration risk, unfortunately, played a part there. And then there was this third invention called the future receivable. These are essentially, are they fresh air receivables? Are they real receivables? Are they enforceable? Questions that obviously were not answered, because when we think about receivable financing, there are 3 points that we need to first tick off the boxes. Does the receivable exist? So you're talking about a future receivable. So obviously the receivable doesn't exist. Number two is the next question is, if it exists, then is it assignable? And third, is it enforceable? So what's the basis on which that receivable was created? Now, all these fundamental precepts were not met. And we suddenly find ourselves looking at a situation where future receivables are part of a risk portfolio. So clearly the oversight was lacking. Clearly the way in which the financing propositions were put forward was unethical at best. And the consequence was not surprising. It had to blow up at some point, and it did. So regulation, compliance, governance, how is this going to be done is a matter of concern, not only for the promoters of these alternative promoters of financial services, but also most importantly for the consumers and for the governments of all the countries where these institutions operate. So this is something that is not a question that has been answered as yet. Moving to the commodity finance side, I've had a ringside view sitting in Singapore of many of the commodity finance problems that occurred. And it is sometimes suggested it's a Singapore-specific problem. And the answer is, I would vehemently say, no, it's not a Singapore-specific problem. It is something that occurs in different geographies. And it just so happened that there were a collection of events in close proximity in terms of the timing at which it happened, and it sort of drew a lot of unwelcome attention to Singapore. Because at the end of the day, the banks that were seriously hurt by it were the international banks. So these international banks have norms, and they don't have special norms for Singapore. Whatever norms they have at their head office is the same norms that they apply in Singapore as well as in other markets. But still, there was a failure. Now, the strange part of the fraud, like the Hin Leong fraud and several crude oil and oil products related frauds, was that the fraudsters, or those who committed an offense on the bank, used age-old practices to fool the bank. Like, for example, using multiple shipment documents to seek financing. So there were obviously forged documents that were being presented to banks, putting forward fraudulent contracts and taking pre-financing against that, suggesting that there are goods in a tank or in a warehouse, and against that security, take a loan. So there was nothing particularly inventive about the way in which these frauds were committed. and yet the banks fell for it. So the question bears the question, where was the oversight? Where was the vigilance? Where were the controls? And did the banks become too casual? And did they sort of just have faith in the fact that, oh, this is a very good customer of ours. They're such a big customer of ours. They're the biggest in the world, and they can't possibly be doing anything wrong. And so we'll just go along with this. And it suited many of the banks fine as long as the transactions were turning around. But once the oil prices collapsed, when Saudi Arabia and Russia got into a tiff, and that led to a spiraling down of the oil markets, it suddenly became visible as to who was exposed. In the case of Hin Leong, apparently, there were significant portions of their assets that were not hedged. And so when the oil market prices crashed, it was just simply too late. And it became inevitable that their misdeeds would be revealed. And that's precisely what has happened. Now, the consequence of that has been that many of the major commodity financiers have shrunk their operations. The case of Ibn Amro Bank, which has completely shut down its commodity finance business. There are some French banks who have shrunk their business and taken it away from the Asian offices or concentrated it in certain Asian offices. Or reconfigured their organization to be a much more controlled, a smaller organization. So these are measures which sometimes to a layman or a bystander appear to be like knee-jerk reactions, because at the end of the day, the commodities still need to flow, still need to be bought and sold. There's continuous production, there's continuous sales. So who's going to do it? Are the other banks going to just now step in and take advantage of the gap made available by the commodity finance banks? And this, in fact, is a repeat of history, because there was a point in time in the last decade when European banks suddenly faced a liquidity crisis, a US dollar liquidity crisis. And as we all know, commodities, more than 95% of commodity flows are financed in US dollars. So when they started suffering shortages of access to US dollar liquidity, they sort of turned away transactions. And I can tell you in Singapore, the local banks stepped in very aggressively, and they took a significant part of the market share. So banks that were previously not present in the commodity finance business have stepped in and taken away those portfolios. And now for the foreign banks to regain those portfolios, if they were to come back to Singapore, I'm not going to say it's impossible, but it will require a lot more effort. But we're hoping that there will be continued interest in financing commodities, and that it will be done, of course, in the right way, and that banks remain safe, and they earn the returns for the risk that they're taking. So let's hope to see that turnaround occurs. But right now, there's a lot of soul searching going on.
Great. Just picking up on one or two points which you mentioned. One, you talked about that green seal, the way they have done, obviously, that was trying to put together in that portfolio or in the securitization bucket, the kind of asset liabilities or the commitments which didn't exist, future receivables from future billing, etc. That's something totally unheard of. I won't say totally unheard of in banking. In banking, banks do finance future receivables, but not as a part of the trade finance, not under this kind of thing. It was
just to be clear on that, Mr. Sindhwani. Yes, we do finance in anticipation of future receivables.
Yes, that's
to be very precise. So yes, there are part of the supply chain, such as the procurement phase, the manufacturing phase, the storage phase. Ultimately, that leads to sales and receivables. So yes, we would have financed it in anticipation of those future receivables. But suggesting that I can monetize a future receivable now is an entirely different idea.
All right. Obviously,
you can't accept.
Obviously, this is something which, right at the beginning, you mentioned about the key features of the trade finance, which is short-term, secured, and self-liquidating. It then tick all the boxes. This was something which was outside it, but it was put into that box. giving a kind of impression that it meets that criteria. That's the first
Absolutely.
point which went wrong. But there was a third party involved. I have seen that I believe there have been instances in the market where borrowers have tried to put it into that kind of category, knowing fully well maybe either they were going through some other kind of pressures, liquidity pressures. They thought this is easier to get it, trying to put forth a proposal to the bank which seemingly appeared to be a trade finance. Actually, it was not a trade finance fund. It was not like that. There have been instances like that also without the involvement of a third party, where again, you made it a right point. There have been kind of instances where there's nothing new. The scamsters have not applied their mind. They have used the old traditional tricks, and the bankers have fallen for it.
Yep.
And
So
that's I think that's what the human history is about. We continue repeating the same mistakes time and again, but maybe with a bigger price we pay every time for it. Something like that. These incidents also have happened. Something which is coming to my mind is about a year or two back, which something happened in that Gulf market. I think it was, if I'm getting the name right, NMC Health, I believe.
yes, yes,
There also many banks had to take big knock, and which was clearly, I don't think there was any third party involved. Banks were getting carried away by that. Yes, this is a large company, this is a good credit, this is an established player, how can anything go wrong over there? And they lowered their guard on so many things, and it was becoming more like a routine which was taken for granted, and things fell apart. Something about that, what is the lesson for banking community for
yeah.
us from that?
From what I've read about NMC Health, it's a case of wholesale fraud. It's a business that reflected the ambitions of a promoter who was really looking to grow the business probably much faster than they were capable of managing. And that required a lot of funding. And in fact, the name of Greensill is also tied with that. And one of the issues that have, shall we say, dogged supply chain finance industry as a such is the way in which the large corporate on whose behalf the supply chain finance is being provided, the way the large corporate books its obligations, because at the end of the day, they're still a payable. Now the question is it classified as a trade payable or is it classified as a payable to bank, due to bank? And that can change your leverage ratios. So what has basically happened is a case, I believe, of what I would call, in my own terminology, balance sheet gymnastics. So where the balance sheet is made to look a lot better than what it actually is. The level of debt that a company has taken is much higher than what is being reflected on the balance sheet. And like I said, one of the biggest, shall we say, risks that banks and businesses are constantly facing, which they're not able to control, is price volatility. So that is a market feature. And many of the unhealthy state of borrowers as well as of the banks or financiers has actually been revealed when there's adverse market movement in the prices of the underlying assets in which they're interested in. So price volatility is something that you cannot always hedge because of the type of assets that you might be transacting. But that has been one of the, shall we say, triggers for collapses occurring. And that's, I can certainly point to that when it comes to the case of NMC Health. I can point that to the case of Greensill and also the case of Hin Leong, which I made reference to earlier in terms of the commodity finance frauds. The accounting regulations have not addressed this particular issue. So I believe there must be a conversation going on at various levels to remedy this lacuna that exists in terms of how to classify obligations due to a supply chain finance lender. So this is something that work in progress again. So we're learning from these mistakes, and a lot of major corporates have sort of taken advantage of this loophole, particularly when they're desperate for funds. And it's been my experience when I was a lending banker that I would start getting very, shall we say, nervous or more cautious when I see one of my customers having a certain spurt of activity. which is way beyond their normal pace of activity. And because one of the first things I'd be concerned about is, are they, how is their current, just look at their current account, and at what rate is funds coming in, at what rates are funds going out, or are the funds just remaining in the account? Are they using the funds to meet their liabilities across the board? Are they reducing their total liabilities? Or is that a specific market situation that allows them to suddenly increase the pace of their activity? And if you don't get clear answers for that, then you're already getting advanced signals that something is waiting to blow up right now. So better take some corrective action. And get all the decision makers in the room to agree on your course of action. But it's a difficult decision to make because everybody's hungry for market share. Everybody wants to be in the good books of the client. So one has to move against the grain and say, no, we're not going to do that. We're going to go move the other way. And let the customer pretend that they're absolutely fine with us withdrawing. But we'd rather withdraw and minimize our exposures rather than wait till the final day and then be amongst a group of people staring at our navels and saying, now what should we do next? Because the whole matter is out of our control.
That's very well. The way you have explained it, that reminds me of something of 2008 global financial crisis. The things went on very, very, you can say, good, or in continued moving in one direction for so long that people who are sitting on the fence, who are saying this is something not acceptable, can't explain, they also sooner or later were forced to jump into that fray. And finally, when the tide subsided, there were so many people found without any clothing or without any coverage. I hope this issue, whatever we are seeing in the trade finance, is not that widespread and not that universal that it will bring the entire world economy down. I'm only hoping. But one point which you mentioned about that accounting principles and how it is shown in the borrower's book as a trade payable or due to the bank, or it becomes local. You said that balance sheet, I will say balance sheet management. I won't use that term which you brought in over there. that is more interesting.
I took the liberty of saying that.
No, very, very, very well explained. That gets the gist of it. So do you think with the now so many things coming into the limelight, and this is under the regulatory scanning also, do you think there can be some changes in that accounting principles, accounting guidelines also, which can have an adverse impact on the development and growth of the trade finance business as far as the banking industry we are concerned? Because to a certain extent, genuine borrowers also were getting advantage because the way it is treated. Now, if there are something comes in over there, because some people have misused, some people have exploited that advantage, and new regulations come in, do you think that the possibility of some new stringent accounting guidelines, regulations coming in, and if yes, that would that have an impact on that overall growth and the way the industry is structured now?
To preface my answer, I must say that I'm not sure I'm qualified to answer this, because this is something that only the CFO for bank might be well qualified to answer. But as an observer and as a participant in the trade finance market, I am not too concerned about the strengthening of the regulatory or the accounting standards, because banks to a large extent are already following it. It is these people of businesses that are outside the bank that probably have a greater ability to change the way they book the loans. The problem is not so much on the bank side as such. The problem right now is on the corporate side. The corporates who are enjoying access to supply chain finance lenders to intermediate between them and their suppliers. So in their books, how that is going to be classified is what needs to change. Now, will that have an overall effect on the future of the supply chain finance industry? Yes, it could diminish some of the volumes, but what we don't want is over trading. What we want is proportional financing proportional to the volume of trade or business that's actually done. So eventually it should work out for the best for all concerned. I guess where the concern I do have some concerns, is on the risk appetite of banks to want to finance trade, to want to finance supply chains. because it is a significant business. It is a very important business. And the MSMEs are very, very heavily reliant on access to supply chain finance. In India, we have the TRED system, which is becoming very prominent in the Indian financial space. And likewise, in every part of the world, there's increasing focus on receivables finance, payables finance, and basically the last stage of the supply chain where goods are ready, all the performance risks are now eliminated, and all that remains is a credit risk of a buyer at the end of the chain. So it's an attractive prospect, and it broadens the scope of banks to deal with not only with the high-rated, better balance sheet backed customers, but also smaller customers. Because at the end of the day, they're not taking really an exposure on the small MSME. They're taking an exposure on the obligor to the MSME, and that if that obligor is of acceptable standing, then that's good for the bank. So and the MSME will also benefit from it. So I don't believe a reordering of priorities and a reordering of the regulatory framework is going to be adversely affect the future access to supply chain finance and trade finance. It's more the risk appetite part that needs to be looked at, and that's a question of every institution choosing which part of the market they want to get involved in. Because we talk about a trade finance gap. ICC and Asian Development Bank came together, and in their study, they estimated a few years ago that the trade finance gap is about 1.5 to 1.6 trillion dollars, and a large part, or almost all of that, is attributable to the fact that the bottom 50% of the industry, of the business sector, doesn't get access to funding. And this is a serious problem, particularly in the developing countries. Now, Standard Chartered came out with another study sometime, as I recall, in July 2020. And they said on account of recent events, the trade finance gap could have expanded to $5 trillion. Now, these are frightening figures, really frightening figures. And developing economies just cannot be sustained if that is the level of gap between the supply of trade finance and the demand for trade finance. So something urgently needs to be done. It is a major priority.
That's, I think you said it very correctly. The gap which is there, it is just an estimate, and there is no reason for us to feel comfortable that gap would not have increased the way the situation has panned out in the last 1 year. I'm sure it would have expanded only, and I'm not surprised by the numbers which has come out by the Standard Chartered over there. And very truly said that it's the bottom 50% which is the impacted, and that's where I believe that the new players, the technology, because the key problem for the banks to accessing or reaching out to those is the cost involved in that entire process. And sometimes maybe these bottom 50% people they are not that well structured. They are not well, you can say, the entire systems are not well documented, etc., which doesn't meet the banking system requirement. It doesn't perfect match. It doesn't come fit into that banking systems over there. That's where that intermediaries can play a better role over there, and the technology can bring a better role in improving the turnaround time, improving the overall processing time, and also taking care of that compliance and AML requirements. So this was quite, again, maybe very exhaustive thing. The trade finance, now I'm realizing there are so many things which we could have continued talking about, continued discussing, starting right from that, the very nature of the trade finance, then the complexities involved, and how it can bring you into that KYC requirement, as you mentioned about that point which comes to my mind, that KYC is not a one-time exercise, it's a regular ongoing exercise.
Ongoing,
KYC,
all the time.
AML, and these are AML also, and trade-based money laundering, all these things are so intertwined, so closely connected with each other, that as a banker we cannot lose sight of one over the another. We have to take care of all, each and every aspect, and that also not at a reasonable turnaround time, and also at a reasonable cost, so that we can't lump that entire cost of the end user, because that entire exercise goes for a toss, then it doesn't serve any
Yeah,
purpose.
it becomes pointless.
Yeah, and there is so, and I'm sure that this discussion with a person like you with so much of depth of knowledge and wide experience, we can continue on and on. But in the overall interest of the time, I think we have already stretched beyond our expected time, which we had requested you for. And I'm seeing that some of the points which are coming sideline on that chat mode, most of these things have already been covered, and you have been taking care of that alongside covering all those points as well. So I'll just simply would like to say thanks very much on behalf of PEDI, on behalf of all our members, and I'll say that Indian trade finance community, which I can see the appreciation which people are sharing on that chat mode.
Thank
Thanks
you.
a lot, Mr. Keshavan, for your time, for your explanation, the way you have put forth the various more intricate issues, etc., in a very simplified, lucid manner, and explained it. What are the points where the things can go wrong and what we have to be careful. And I would like to share with you just our next discussion for the next month is going to be focusing on digitization of trade finance, which we are going to be doing in coordination with ICC, because as you know that ICC has been working on the digitization roadmap and so many things. So
Sure.
we'll be soon coming out with that details of that also. So thanks a lot for your time, for your support, and we hope to keep in touch with you and continue getting that kind of support from you in the future as well. Thank you very much, Ms. Keshavan.
Thank you, Mr. Sindhwani. I thank you, all your colleagues, Mr. Ganeshan, who's been in touch with me. And I thank the audience who've listened in. I'm honored to buy this invitation. So please feel free to have me back for any discussion you might need. I'm happy to participate. And I thank you for this opportunity to spend some time with you. It's always stimulating to have such discussions. And if there are anybody who requires reading material on any of the topics that we've talked about, they can reach me by email, and I'll be happy to provide the reading material that I might have readily available for them. Thank you, and wish you all a good evening.
Thanks a lot. Thank you, and wish everybody a safe time. Take care of yourselves. Stay safe.
Absolutely. Can't be
Thank you very much.
overemphasized. Bye-bye.
Thank you. Bye-bye.